Hello, everyone, and welcome to another episode of my Company Health Check series. For those of you who have not watched my previous videos before, do remember to check them out, and also, of course, remember to subscribe, as that would help me out greatly. Here, I will share my occasional updates of my portfolio companies I invested in and I'm still holding. I will analyze them using the bottom up approach, usually by looking at the quarterly reports all the way to the full year and make estimates beyond that. I believe that by journaling my research in video format, I hope I can make myself more informed of my past decisions, be it whether it's right or wrong, and also share my insights with everyone here. Hopefully, all of us can benefit in some way, especially to fellow active value investors like myself. So, without further ado, let's dive into Kraft's Q3 latest report results. So we start off first by looking at Kraft's segmented revenue for Q3 2023. The top three largest share of revenue for Kraft is Taste Elevation, Fast Fresh Meals, and the Easy Meals Made Better divisions. Kraft's Taste Elevation focuses on sauce and condiments. This division performed modestly with a year-on-year growth of 7% and in its 9 months ended, a year-on-year growth of 10.81%. But if we look deeper, right, quarter on quarter, there is actually a decline of 9%, which shows some weakness already in its most valuable part of its businesses. I, however, noted that some good traction in its convenient meals business, though, but this is actually quite a small part of its business only, where all measures, whether be it the year-on-year growth and the quarter-on-quarter, all resulted in a positive growth. But if you look at the overall picture, revenue growth on all its segments overall only grew a small 1 percentage point year-on-year and even declined 2.25% quarter-on-quarter. So I have also put up a segmented revenue by product category for comparison, as you can see at the bottom of the pic. So you can see product category below, right? We noted here that based on product category, there are 4 segments that gives Kraft the largest revenue shares. So the top contributor being sauces and condiments with their Taste Elevation portfolio. And number 2 is in the cheese and dairy division. And number 3, ambient foods, which includes canned products. And number 4 is the frozen and chilled foods. You can see that the gap here is quite large for the revenue shares. So from the number 1 revenue generator, which is the condiments and sauces, and all the way down, there's a very large gap difference. So you can see how important the condiments and sauces businesses is for Kraft. All right, but to my disappointment, the sauces and condiments business have revenue share have declined from 35% last quarter to only 32% this quarter. Therefore, there might be some slowing down observed as average prices in Kraft actually grew by 7.1 percentage points over the same period. And this has partially offset 5.4 percentage point decline in the volume mix. So let's look at the competitor. I've brought up Campbell's Soup's performance. Okay, so Campbell Soup has a market cap of 12 billion, while Kraft has a market cap of 40 billion. Campbell Soup overall increase in revenue of 8.5% versus a negative 2.25% decline for Kraft shows that Campbell has definitely performed better than Kraft in terms of revenue on all fronts. Inventory turnover seems to be also performing better than Kraft too, at 5 times for Campbell versus just 3.5 times for Kraft. Campbell seems to be coming into good value territory as well. But if we looked at Campbell's median PE, okay, versus Kraft median PE and its current price, Kraft seems to be have been more oversold compared to Campbell. But because this is due to Kraft's continued poorer performance versus the industry. So my overall consensus is that Campbell seems to be definitely doing better than Kraft. Okay, now we look at management outlook for Kraft. So management's latest strategy is to drive sales through a chef-led model leveraging on the dedicated chef network to create tailor-made menu solutions to customers, and then prioritizing them into higher margin spaces by expanding across attractive channels like non-commercial with higher growth and higher margins. Management also focus on growth in emerging markets via a data-driven, repeatable go-to-market model to drive its distribution. Okay, this will expect to have approximately 90% of emerging markets, the go-to market design and ready for implementation by the end of 2023. And this is what they estimate to grow from there, right? And management will also increase marketing investment by 25% versus the prior year, with a focus on its growth platforms, which is a new model that they have implemented. So management, however, also emphasized that while increasing marketing dollars, they will need to embrace a holistic and sustainable approach to marketing, inserting themselves into the culture instead before putting in the marketing dollars. Management also highlighted that they will be solving remaining isolated supply constraints to improve the stockage efficiency. Management also observed organic declines, and this is mainly due to the weaknesses of its meats business in North America. And they will be trying their best to revive this business as long as it generates higher adjusted EBITDA on lower organic net sales in meats. Also, a new product launch has been called Ketchup and Seemingly Ranch, and this became an overnight sensation, sweeping the news online and even spreading internationally, with consumers clamoring to get their hands on the product. This launch for management demonstrates a test to Kraft's powerful agility and how its teams are using the new agile at scale model to move at the speed of culture on its innovation front. Digital solutions too have helped to contribute to the annual gross efficiencies target, which has accelerated to 500 million for 2023. With this, management expects volume trends to continue to improve. Management has also expect moderation in the inflationary pressures going forward. But in view of the challenging environment for Kraft, management lowered its outlook for the full year in terms of sales growth at the 4% lower range, while management also estimates that the full year earning per share will be around 2.83% in the lower range too. So bearing for any uncertainties, I too have lowered my full year estimates to the 2.70 to 2.80 range for my valuations. Okay, let's look at the historical P&L for Kraft. I've tracked Kraft's sales from 2006 to the latest 9 months ended 2023. Historically, net profit margins for Kraft is mostly in the mid to high single digit regions. During the financial crisis in 2009 to 2011, they still managed to maintain a high single digit in its net profit margins. Also, during the COVID period in 2022, Kraft managed to pull in a net profit margin of 8.92%, which is still impressive if you compare this to its own median average. This will give Kraft an edge on its operations should all strategies be executed successfully. If you looked at this year's P&L or the 2023 9 months trailing P&L, you can see that there's an impressive improvement in its net profit margins to date of 10.6%. This might be due to the strategies and models put in place to gain efficiency to improve adjusted margins, and primarily driven by the divestiture of its lower margin nuts and cheese business, as well as improved productivity. Management is committed to deliver a 3.3% of cost of goods sold of 500 million on a go-forward basis, with benchmark on the 4% level. So this seems to be actually hitting their KPIs quite reasonably well this quarter. So hopefully management can maintain this result going forward. Overall, the P&L still seems pretty resilient. On the balance sheet, Kraft's debt position is still indeed large at $19.8 billion as of September 2023. Debt is currently standing at a huge 40% to its shareholders' equity as at third quarter 2023. I noted that a small portion has been redeemed this year though. However, Kraft fortunately still has a healthy times interest earned ratio of 5.1 times this quarter, indicating comfort in servicing their interest payments to date. As a FMCG retail business, it is also important to know how Kraft manages its inventory. I noted that Kraft's inventory turnover for their finished goods declined 0.5% year on year to a 3.55 times inventory turnover for the 9 months ended 2023. As we recall from our competitor analysis with Campbell, this still pales in comparison with Campbell and indicates slower inventory movement as compared to its competitor Campbell. Historically, Kraft's net ROA seems to be very strong in the double digits, but since 2022, the net ROA or return on assets have declined to single digits. This may be due to its excessive debt it has taken on in the recent years. On its return on invested capital for Kraft, this remains very small at 2.85% and only improved slightly from the last quarter. And for Kraft's earnings yield for my equity returns, this yielded 5.85% this quarter, which is still decent considering that this is already a matured business that Kraft is currently navigating in, and for this during this high inflationary environment. So Kraft generated $1.8 billion worth of free cash flow this quarter, or 22 times its current valuation. This is on the back of $500 million worth of capital expenditure expense out so far this year. Because of its strong free cash flows, management have decided to continue paying a dividend of 40 cents this quarter per share, and this is a 4.9% yield to its current share price, which is rather attractive. So for its valuation, let's now look at them. Kraft's current forward PE is at 17.5 times. Its median PE is at 20 times, while the industry PE is currently at 22 times. And based on my PE forward valuation metric, I lowered Kraft's share price to be in the $30 to $38 range to reflect its poorer performance going forward. Kraft's share price seems to have corrected to reflect its uncertainties underlying the business and weaker performance if compared to peers like Campbell. As mentioned earlier, Campbell is indeed a better performer. My DCF or discounted earnings valuation sets Kraft's price at a lowered valuation of currently 17.30 per share versus the previous 25.54 as I mentioned on my previous videos. So this is a premium of 46% above its current price. And without major improvements for 2024, I believe that the share price will be muted or even decline further. It is important that the new CEO is able to execute their said plans well, of which I'm currently skeptical due to its continued poor performance versus its peers to date. In conclusion, I think that although Kraft's current share prices look attractive versus its peers and also its historical valuations, the share price has been punished for a good reason. Previously, I mentioned that Kraft has entered into an attractive price range close to my margin of safety. I would like to take that comment back and will instead sit and watch the company's future performance subject to its strategies mentioned by management as of recent. However, dividend yields look more attractive now than before, and in fact, it is even more attractive than its peer Campbell Soups. This shall be the only plus point to Kraft now until we see more improvements in the future quarters. Till then, for the win guys, and let's identify more good opportunities in this market during the uncertain volatile season now. Alright, and see you in my next episode.